Yeah, I mean that's key, and picking up on that. I think investing is about the long term. It is about diversification. The way that most of the portfolios we look after, particularly ones we use long sec for, is that we're going to have exposure to all the sectors, but there's times where we're going to tilt. Some of these macro environment things are going to be important there to tilt either way. It's not an all or nothing. It's okay. Are we overweight, underweight, that kind of stuff as well. So I suppose continuing that theme a little bit, I suppose consolidation or the big companies getting bigger, those kind of things, either in Australia or overseas. Different change in Australia, but CommBank, BHP, those kind of guys are taking up a fair size of the index, and overseas, I suppose some of those tech companies around the globe are inching up, and the bigger are getting bigger. How do you see that playing out, I suppose, in two parts? One, in 50 years, will it just be four companies and they're going to own everything? And then in the meantime, how do we find that concentration risk of, okay, that stock was, I don't know, NVIDIA was only this much a portfolio, now it's that much. How do we find the right level of diversification as these companies grow and become bigger?
Yeah, it's become a bigger issue of late, but look, it's something that's always been, because you've got your sort of super companies growing, outperforming everyone, and they go through these phases, and they become very large. We had energy companies in the past, or resources, or banks domestically, but that's a fact of life. It is what it is. They're on top of the list, and they've got larger allocations in certain markets because they've been such successful businesses. So there's a reason there why they've got such a large allocation, large size, because they've been really successful and very profitable. But from our perspective, we are trying to achieve an objective by managing our portfolios, and diversification is key. You don't want to put all your eggs in one basket, and this is more about just the number of investments that you hold. The key to long-term success is identifying 15, 20 investments that are not correlated. That maximizes your returns and manages the risk. And that's why we spread investments across asset classes, stocks, bonds, commodities, geographies, to gain that. And there's a drawback of that strategy when, particularly domestically, we're just going through it right now. We've got the two sectors in the market forming more than 50% of the allocation in the Australian equities market. So you've got your big four banks, which are all correlated together. So it's essentially one big exposure to banking. And then you've got the big three miners, which is Fortescue, BHP, and Rio, which gives you a massive exposure to those bulk commodities and iron ore. So essentially, half your portfolio is exposed to two themes: iron ore and banking. Now, they might do really well, and by having that exposure, you'll do really well. But the risks are significantly high, because if that doesn't pan out, that is going to end in a very difficult, different outcome. So that's why the exposure to those underlying sectors is really monitored by us, to make sure that there is no over-reliance or too much of an overweight to one particular sector that can have an adverse outcome for returns if things don't go well. Last 12 months, we have seen the resources sector return 44%, which is phenomenal. So that's a part of the market that's returned 44%. Everything else, which is the other 75% of the market, is down 1%. So you can see the divergence and the disparity. So if you were too skewed to resources, you would have really fantastic returns. But if you were diversified into the X-resources space, your returns would have been muted. So, and most people should have probably been sort of more balanced between the two. So you're not going to see those returns at the market level, because the 44% return from that one particular sector has skewed returns. But at the same time, the risks for that particular portfolio would have been very high. So from a risk management perspective, we need to diversify, and it's the same case in US equities. Those 7 businesses form over 30% of all the market cap in the United States. So that is on an absolute sense a very high allocation to have, just to 7 businesses, which are pretty much driven by a very similar theme of technology and potentially AI now. So the way we manage that is to reduce the weighting that we have in the portfolios to those specific themes, just from a risk management perspective. Doesn't mean we don't like it, doesn't mean they're not good companies, but you've always got to keep in mind we need to be diversified. We need to have, we can't have too much exposure to that one particular theme or asset class or underlying asset, because if things don't go well, that's going to really cause a deep drawdown that we're trying to avoid.